Hey guys, what's up? I'm Erin and welcome back to the channel. If you lose a spouse, the emotional toll can absolutely be overwhelming. But what a lot of people don't realize is it also triggers one of the biggest tax shifts of your life. In the eyes of the IRS, your filing status changes, and that can mean a greater percentage of your Social Security is now subject to taxation, that you could face higher Medicare premiums, and face a larger tax bill on your RMDs. This isn't just paperwork, it's a financial turning point every single married couple should plan for. And that's why it's so important to understand what's coming, not just in a vague way, but in exact terms. Because this is a change. If you see it coming years in advance, you can plan ahead and you won't be caught off guard. In IRS terms, this is called filing as a qualifying widow or widower, officially known as a qualifying surviving spouse. It's a special filing status you get for 2 years following the year a spouse passes away, but only if you meet certain eligibility requirements. And understanding when it ends and how that shift affects your tax planning is critical for retirement planning. So here's how it works. In the year of death, you can still file as married filing jointly or separately if that was what you normally do. You're considered married for the entire year even if your spouse passed away on January 1st. First year after death, if you qualify, you can file as a qualifying surviving spouse. This means 3 things. 1, you didn't remarry during the year. 2, you have dependent children living with you, biological, adopted, or stepchildren, not a foster child, and you paid more than half the cost of keeping your home. You must meet all 3 of these criteria. The second year after death, the same rules as the first year apply. The third year after death and beyond, that special status is gone. You'll file as single or head of household, depending on your situation. But what if you and your spouse are in your 60s or your 70s and you don't have dependent children living at home? They're grown and have long since left the house. Well, this is where a lot of retirees can be caught off guard. Without a qualifying child, you skip right past the qualifying surviving spouse, and here's what that timeline looks like instead. In the year of death, you get to file as married filing jointly. The very next year, you move directly to filing as single. And that change isn't just the title on your tax return. It can come with very real consequences. Your standard deduction is cut in half. Tax brackets shrink so the same income can push you into higher rates. More of your Social Security can become taxable. You may hit Medicare IRMAA surcharges sooner. This is why surviving spouses, especially in retirement, can experience a sudden jump in their taxes even when their income doesn't change much. That's the reason it's called the widow's penalty, and it can cause a very real tax consequence. Here's where the big tax surprise comes in, especially for retirees. When you go from married filing jointly to single, all of a sudden your standard deduction drops. Those tax brackets get tighter. A greater percentage of your Social Security can be subject to tax. Your Medicare premiums can increase more suddenly than they otherwise would have. So even when your income doesn't change, all of a sudden you are paying way more in taxes. And this is a reality for many retirees. So let's walk through an example. First, we'll look at a couple where both spouses are alive. Bill and Alice, both age 75. We'll look at exactly what their income looks like, how much of their Social Security is subject to tax, and ultimately what their federal tax bill looks like. So this will help us to establish a baseline. Then we'll look at what happens to this situation once one spouse passes away. So let's break down their income. Let's say Alice receives $1,500 a month in Social Security payments, or $18,000 for the year. Bill receives $2,500 a month, or $30,000 for the year. In total, they receive $48,000 in Social Security benefits. Now, both are at RMD age, and both have been savers, so they both have to pull an RMD from their traditional 401k accounts. Bill has to take a $20,000 RMD from his account, and Alice has to take a $16,000 RMD from her account. So in total, their income is $84,000. The first step is to calculate their provisional income, and this helps us to determine how much of their Social Security ultimately ends up being taxable. So here we look at half their Social Security benefits plus any other taxable income sources. In this situation, their provisional income is $60,000. Then we have to use this to figure out what portion of their Social Security is taxable. The good news is that it's never 100% of your Social Security benefits that are taxable. The maximum amount of your Social Security benefits that could be subject to tax is 85%, but it's not a guaranteed 85%. We have to plug our numbers into a formula, and ultimately it is the lesser of the two amounts that is used. So when we plug our numbers into the formula, we use the lesser of the two outcomes, and in this situation, we find that $19,600 of their Social Security benefits would count towards taxable income. Then we want to calculate their total federal tax bill. We use their RMDs, which are taxable income, and add in the taxable portion of Social Security and find that their taxable income for the year is $55,600. We subtract any current deductions that they are eligible for. In this situation, we'll use the standard deduction for those married and filing jointly, and the additional standard deduction for both spouses being over the age of 65, as well as the additional $6,000 per person temporary bonus deduction due to the passing of one big, beautiful bill. Ultimately, their total deductions are $46,700, meaning their taxable income after deductions is just $8,900. Then we apply the tax brackets for those married and filing jointly. They are entirely within the 10% bracket, and their total federal tax bill is just $890. Even with two fairly substantial RMDs as well as Social Security payments, these large deductions keep them entirely within the 10% federal tax brackets. I think that's pretty incredible. Bill and Alice start out with an income of about $84,000 and they end up only paying $890 in federal taxes. Now let's look at what happens if Bill passes away. The first big change is that Alice is going to switch over to Bill's Social Security benefit as her survivor's benefit. Bill was receiving a higher dollar amount. He was receiving $2,500 a month, while Alice was receiving $1,500 a month. So when he passes, she will switch to his benefit because it was the larger of the two. The second change comes to retirement accounts, but in this situation, there isn't that big of a shift, and we'll talk about why. Because Alice is the surviving spouse, she has a few options of what she can do with Bill's 401k. She can leave it invested as Bill's 401k and continue taking RMDs from it based on his life expectancy, or she can roll it over into her own IRA, at which point she would have to continue taking RMDs from it based on her life expectancy. Now remember, in our example, both Bill and Alice were the same age. So in this situation, we're not going to experience a big shift. If Alice had been younger than Bill, she would be able to roll this over to her own IRA, and assuming she was younger than RMD age, she wouldn't be required to continue taking RMDs until she hit that age herself. But because in this example, she was 75, she still has to continue taking those RMDs. For simplicity for this example, we're going to assume that the market was fairly stagnant in this 1 year and that the RMDs don't really change. But this is important to consider when you have sizable traditional 401k balances, as we can assume that Bill and Alice do based on their RMDs. These accounts would continue to grow over time. And this is what can make that widow's penalty especially painful, because that would make it so your RMD continues to grow year over year over year and ultimately increases your tax bill every single year. Alice is receiving the survivor Social Security benefit of $2,500 a month or $30,000 a year. Alice has to take her own RMD, which is $15,000, and the RMD from Bill's inherited account, which is $20,000. Her total income is $65,000. Then we'll calculate her provisional income, where we use half the household Social Security benefits plus any other taxable income sources, and we find that her provisional income is $50,000. Because her filing status is now single, that Social Security taxation threshold is now much lower. $25,000 for the first threshold and $34,000 for the second. That means a larger portion of her Social Security will be taxed compared to when she was married, where the thresholds were $32,000 and $44,000. We will then calculate the taxable portion of her Social Security benefits, and in this situation, it ends up being $18,100, and ultimately then try to calculate her total federal tax bill, which will include both RMDs and the taxable portion of her Social Security, which gives us $53,100. Then we apply the standard deductions she is eligible for, which is the standard deduction for those with a single filing status, the additional standard deduction for her being over the age of 65, as well as the temporary one big beautiful bonus senior deduction of $6,000. Total deductions, $23,750. Ultimately, her total taxable income is $29,350. Then, once we apply the federal tax brackets, we see that her total tax bill is $3,283. Her tax bill as a single filer is about 3.5 times larger than when she and Bill were filing taxes as a couple, even though her income is lower. This is the heart of the widow's tax penalty. When you switch from married filing jointly to single, your tax brackets shrink and your Social Security thresholds drop, which can push you into higher taxes even with less income. For the sake of simplicity with this example, you will notice that we continued to use the 2025 federal tax brackets in both examples, and that's quite simply because the 2026 federal tax brackets aren't available yet, but the concept remains the same. The true point is to illustrate that there are great advantages to being married and filing jointly. You have a larger standard deduction, and those tax brackets are more generous. Now, in this example, you might be looking at those tax bills going from just under $900 to just over $3,000 and thinking, what's the big deal? She can still afford it. But it's not a one-year event. It's what happens over time. While Alice's RMDs from her own account might be $15,000 or $16,000 today, and the RMD from Bill's account about $20,000, in 5 or 10 years' time, those RMDs could be several thousands of dollars more, and this would continue to push her into higher and higher tax brackets and increase her tax bill. And as her income increases, a greater percentage of her Social Security becomes taxable, and she might be getting close to hitting those IRMAA thresholds over time, which would increase her Medicare premiums. All of this would lead to extra costs for Alice. This is the widow's or the widower's penalty in action. It's not just about that first year after you lose your spouse and the tax hit you receive. Instead, it's about the ongoing growing tax burden due to a permanent change in filing status, and it is especially concerning for those who have been diligent savers all of their lives. So how do you plan for this? Here are a few practical steps. First, model the single filer scenario now. Don't just always look at your taxes as a couple. Run the numbers if something were to happen to either of you. Take a look at what the standard deductions would be, what your tax bill would look like if there was a sudden change. Second, consider strategic Roth conversions while you're still married and in lower tax brackets. This can shrink your future RMDs so you have less future taxable income that would force you into higher tax brackets. Get your money where you have more control over it, when you have time on your side and when you have the tax brackets on your side. Third, if you can, manage RMD growth. RMDs tend to get bigger over time, especially with robust accounts and strong markets. So what you can do is withdraw more than the minimum, or you can also take advantage of qualified charitable distributions. Fourth, time big income events. If you have planned larger withdrawals or you're planning on selling a property, try to do these things when you still have the status of married filing jointly. And finally, watch out for IRMAA thresholds. A higher income can increase your Medicare premiums, so know where those thresholds are and plan accordingly. Planning ahead and keeping all of these things in mind can help you soften the blow of the widow's penalty when it happens and keep more money in your pocket. Losing a spouse is hard enough without having to consider the financial shock that can happen afterwards. As we saw in our example with Alice and Bill, you can end up paying triple the taxes on even a lesser income. You can't stop the change in filing status, but you can plan for it. And the more proactive steps you have, the more control you have over the future. So what are your thoughts? Is this something you've considered? Let me know in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Child, you skip right past qualifying surviving spouse passes away. Forgot something important that I wanted to say. Going back. Then we'll run. Pronounce the R. Helps us to determine, slow down in the words. Social Security. Do you hear the truck beeping, dog growling? We're all having a moment. So we're just gonna sit here for a second. Hey baby, it's okay, it's outside. We'll just let it go, okay? It'll be done in a second. Thank you. Shush, shush. Thank you, lovey. Shush, shush. Thank you, thank you. Social Security, and we get a total Social Security pen. Oh my goodness. Ugh.